Our session will be on stock valuation. So stock valuation is a very cardinal topic in corporate finance where we discuss the types of investors who own a business and the types of stock that they hold. So we have what is called preferred stock. Stock, to start with, is simply ownership that shareholders have in a business. It may come through what is called preferred stock or ordinary share holding, which is also called equity. So preferred stock is simply the type of stock that promises to pay a fixed dividend, but at the discretion of the board of directors. So these are investors who are speculative, and mainly they receive a fixed percentage of the dividend. They have preference over common stock in terms of payouts. These ones claim their dividends first. So we have a formula for evaluating what is called preferred stock, where we have the dividend on the preferred stock divided by KP, which stands for the required rate of return. So this valuation here, we have a preferred stock which has an 8% payout on 100 kwacha par value. So the discount rate has been given as 10%. The question is, what is the value of this preferred stock? So the dividend payout is simply the 100 kwacha times the 8%. So 8% of the par value, we get 8 kwacha. Then we divide it by the discount rate or the appropriate discount rate. So the 8 divided by 0.10, we get our value of the preferred stock, which is 80 kwacha. So this is how we calculate the value of preferred stock. We also have what is called common stock. This represents the residue ownership position in companies. It's calculated on a pro rata basis of the future earnings after other obligations of the firm, if any, remain. So the common stock represents the interest ownership of the company. It entitles the owners, who are the shareholders, to vote. They have what are called voting rights, but it doesn't guarantee payments of dividends on time. So being the owners of a business, when there is a declared profit, the amount to be shared as follows. We give the preferential shareholders first, and the residue is what the owners get. So in times when there's a bad year, they may even make losses and only allow the preferential shareholders to get their dividends. Preferential shareholders are in two streams. We have cumulative and non-cumulative. The cumulative ones will usually claim what they lost in a bad year, whereas the non-cumulative, as the term implies, they will lose what was lost in a bad year. However, the residue is what the ordinary shareholders would have. They're also called the ordinary shareholders. These are the common stockholders. So the amount varies. If the chunk that remains is bigger, well and good, they'll get it at a higher price. So we're going to labor hard to explaining how to compute the common stock. So there's what is called an intrinsic value. The intrinsic value represents the value of stock today in the market and is determined through fundamental analysis. So a prudent investor will only buy stock if its market price does not exceed what the investor thinks the stock is worth. The intrinsic value really depends on several factors. Number one, the estimates of the future cash flows. Number two, the discount rate. And number three, the amount of risk associated. So in dealing with common stock valuation, we will factor in the issue of the future dividends and the future sale of the common stock shares. So there are two models that we're going to look at. We have what we call the dividend valuation model, and we have Gordon's model. Using the basic dividend model, we are actually going to use the present value of the future dividends. This is solely dependent on the lesson we had in the previous session, where we're calculating the values of stock discounted. Now, the value of a stock depends on whether the dividend is growing from year to year at a constant rate, or it's static, or there is what we call a zero growth rate. So these will actually define what type of stock we're dealing with. So we have what we call under the dividend growth patterns, constant growth, the no growth, and the growth in phases where the growth rate changes from time to time. So we're going to look at firstly the constant growth model. So here we assume that the dividends usually grow at a constant rate or a period forever. In this model, the assumptions are that the price of common stock is equal to the following. We have what we call DO, open brackets 1 plus growth, over the required rate of return minus the growth rate. Now, D0, open brackets 1 plus growth, will give us what is called D1. So this is just the future value that we're learning. So if we have D0 plus so this gives us a formula for D1. If we had D0, 1 plus growth to the power 2, the difference between this period and that period will give us the value dividend 2. If we have D0, 1 plus growth to the power 3. 3 minus 0 is what? 3. So this is dividend in year 3. So basically, if we have dividend 3, 1 plus growth to the power 4, the difference between 4 and 3 is 1. So this gives us D1. All right. Okay. So in short, the power that comes here is a difference. So let me do this. If we have a D4 here, the difference between this D3, 1 plus growth will give us D4. In short, what I'm trying to say is, if you're using the future value formula for A1, this is present value 1 plus G. So this is 0. So 1 minus 0 is 1. So the future value after 2 years using the present value now. Here we're going to have 1 plus growth to the power, this is 2, this is the power 2. If you're looking at the future value for year 7, and you're looking at the present value for year 5, for instance, the power that we're going to have there is 2, the difference between these two there. So I need you to remember this concept because it will help us. If we have 7 there, present value 6, this will give us 1 plus growth to the power 1. So this is where the growth model comes in. So D1 is equal to D0, 1 plus growth to the power 1. D2 is D0, 1 plus growth to the power 2. D3 is D0, 1 plus growth to the power 3. But if you're using the previous year, you can put 2 there, 1 plus growth to the power 1. So this is what the dividend model is all about. So by us calculating the formula of the stock now, it is D0, 1 plus growth over K minus G. So it is correct for us to just say D1 over K minus G, because this is what gives us our D1. K is appropriate discount rate and G is a growth rate. So going back to our template, we're going to now use a constant growth. Suppose the constant growth stock CG has an expected growth rate of 8%, and each stock has just received, whenever you hear the word just, it means that is D0, an annual dividend of 3.24 with appropriate discount rate of 15%. So what is the value of common stock? So remember, value of common stock now will be D0, 1 plus growth over K minus G. So our D0 is what? 3.24. 1 plus growth, 1 plus 0.08. So this becomes our D1. If we're using the D1, we're going to put 3.5. Then our market rate or our appropriate discount rate is 15%. So 0.15 minus a growth rate of 8%. So when you divide this in there, we're going to get a 50. That is the value of stock now. That is the value of stock now. So if we just declared a dividend of 10 kwacha now, and the appropriate discount rate is 20%, and the growth rate is 8%. What is the value of stock now? So the value of stock now is what? D0, 1 plus growth over K minus growth. So this is 10, 1 plus 0.08, everything over 20%, which is 0.2, minus 0.08. So our value of stock now becomes what? Those with calculators. What becomes the value of stock now?
38.57.
38.57. So this is how we calculate the value of stock. So we now go to a zero growth model. The zero growth model assumes that there is no what? No growth at all. So we can still use the same method here, because if there's no growth at all, this one becomes our D1. So when there's no growth, meaning the G is 0 here. So we're simply going to have D1 over the RE. So here we're given a zero growth stock, which is expected to grow at 0% and has just received a dividend of 3.24, and the discount rate is 15%. What's the value of stock? So D1 is 3.24, 1 plus 0, which is 3.24. This is just to show the working, but otherwise, formula is just the very amount over the appropriate discount rate. So this we divide by the appropriate discount rate minus 0. So this is 3.24 divided by 15%, which is 21.6. Then we have the non-constant. This is where much work is involved. The non-constant growth has different phases. So we have a stock that will grow at different rates. So we have a company whose required rate of return is 16%. The dividend growth rate is at 30%. So this 30% is for the first 3 years. Then it drops to 10% thereafter. And the dividend paid just now is 1.82. Let us find the value of stock. So I'll illustrate this using a number line. So we have year 1, year 2, year 3. We are told that we just declared 1 point what? Now. So here it will be 1.80. So we need to calculate the future value of this 80 to D1, D2, and D3 using the constant growth model. Because for the first 3 years, our growth rate is 30%. This is for the first 3 years. So we're now going to use 1.82. 1.82 for the first 3 years. So using the number line, you're going to broadcast this. So this is 0, 1.82. So what is it going to be in year 1, year 2, and year 3? Let's go together. D1 is got what? D0, 1 plus growth. So our D0 is 1.82. Our growth rate is 30%, so 1.30 to the power 1. Okay, what becomes our D2? D0, yes, Mr. Anthony, 1 plus growth, the power what? Power 2. So what do we have here? What do we have here? 1.30 to the power 2. What are we having there? Then D3, please calculate the figures so that we are. Can somebody finish the formula for D3? Katie, D3?
It will be D0 brackets 1 plus the growth, close bracket, and then power 3.
The power 3, good. So 1.82 growth the power 3. So what values are we getting there? So this is a future value. So once we calculate that for year 1, we're going to find 2.366 using the growth model. For year 2, we're going to find 3.076, and for year 3, 3.99. So these are the figures being computed as follows. You understand where the figures are coming from here? Are you together so far?
Yes.
Yes, we're together.
Then for year 4, the growth rate has changed. So we cannot start from D0. I wonder I was teaching you how to calculate the, so this answer here was 3.999. 3.999. So to calculate for year 5, we say for year 4, sorry, D4 will be D3, 1 plus growth to the power what? 1 plus growth to the power what?
To the power 1.
Good, the difference here. So this is 3.999. But the growth rate here, we are told the first 3 years is 30% and drops to 10%. So here we're not going to put 1.3, we're going to put 1.10. All right, because the growth rate has now changed to a 10%. So this is why we're using 3.99, 1.1 here, which is giving us 4.3987. This is because we're using the previous G3. Now, how do we calculate the value of stock? So we need to discount these ones, the present values, each one of them. So whenever we're discounting, we use the appropriate discount rate, not the growth rate. So we want to know how much is this value worth today at 2.36. So we use the formula present value, which is given by present value is equal to the cash flow itself that you have, 1 plus R to the power n, the period of time. So the cash flow that we have here, or the dividend that we have here, 2.33. So we're going to put 2.33, 1.16, because the year is 1. It's going backwards 1 time. So this is power 1. So this 2.3 is actually worth 2.0 because we're taking it today. This one here is under year 2. So the dividend, 3.076 over 1.16 to the power 2. So this 3 is the one we're expecting in year 2, but we want to know how much is it in year 1, in year 0, sorry. So it's coming back twice, so we're putting the power 2 here. And 3.999, we want to also discount this one here to the power 3 so that we know how much it's worth. So the value for these 3 here, we will calculate them. We'll calculate them. So they'll be with 6.888. So the first 3, we are okay. This is the value there because of a constant model. Now, for year 4, we had calculated 4.3989. So since this one is in the next segment, we cannot discount it directly. First, we need to find the value of this one in year 0. So we need to discount this using what we called Gordon's model. So this one here, remember our formula we discussed to say to find the value of stock, V0 would be what? D1 K minus what? Minus G. So our D1, if we're using the number line here, if this is here 4, so this is our D1 here, and this will be our D0 or year 0 here. So to find the value of stock in this year 3, we're going to use Gordon's model. So this model says value of stock now, you can use D0, 1 plus growth over K minus what? Minus G. Or you can say D1 over K minus G. So we have our D1 already. This D1 using this formula here. And our D1 in this case will be 4.3989. So although calling it the value of stock 0 here, in the actual number line, this is in year 3. So the value we're going to find here in year 3, we're going to discount it 3 years backwards. So 4.3989 divided by the appropriate discount rate, 16%, minus 10%, not 30%. It went down to 10%. So the value of stock in the 3rd year is 73 kwacha. 73 kwacha, 0.30 tungwe. So we're going to discount this one here backwards to year 0. So if we're discounting this, we're going to put 73.32 over 1.16, then to the power 3, because we're calculating it from this period of time. So that is the 53.87. So we will now, that is a 46.98, sorry. So we add to the 6.88 for the first 3 years. So where we'll get the 46.98. So the total value of stock becomes 53.87. So this is the most complex way of computing stock valuation. So this is your expected homework. We're given stock GP, the growth rate is 16% for the first 3 years. So 1 to 3 years, 16%. Then it drops to 8% thereafter. Each share stock just received 3.24. So meaning just received, this is our D0. And the appropriate discount rate is 15%. What is the value of stock under this scenario? So I'll expect this work before our next session. I will end here. Thank you and have a good day.